dive right into this explainer and look at a massive shift in Federal Reserve strategy that is literally reshaping how global markets behave today. We're talking about a fundamental pivot at the very highest levels of global finance, a change that impacts absolutely everyone, from the biggest institutional investors all the way down to retail day traders. So, if you've been wondering why the markets feel so incredibly different, and honestly a bit more chaotic today than they did just a few years ago, well, you're in the exact right place. You see, for over 40 years, pretty much every Fed chair used the exact same predictable communication playbook to calm investors, right up until suddenly that historic streak just broke. From the 1980s straight through the 2000s, the Federal Reserve didn't just set interest rates, they effectively managed human psychology. They used their words to shape trillions of dollars in market expectations, which created a nice, smooth ride for the global economy. But then we hit the 2020s, and that smooth, predictable era suddenly came to a screeching halt. So let's get into Section 1, the communication shift, from signals to data. To really get this, we have to remember the absolute golden rule of modern finance. Markets move way before rates actually change. By the time a central bank officially announces a rate hike or a cut, well, the market has usually already priced it in. Traders aren't sitting around reacting to the present. They're constantly trying to front-run the future. Okay, Section 2. What is forward guidance? The 40-year playbook. To understand the shift, you have to know what we lost. Think of forward guidance kind of like using a GPS on a road trip. You don't just know exactly where you are right now, you know exactly where you're headed. Before this concept existed, central banks were highly secretive, meaning rate changes were these massive, volatile shocks. But forward guidance changed the whole shebang. It was basically the Fed saying, hey everyone, here's our destination, and here are the specific turns we plan to take over the next year. It systematically stripped the uncertainty right out of the equation. And the Fed used a whole arsenal of clues to drop these hints. It wasn't just a random speech here or there. We're talking about a highly coordinated effort, from official FOMC statements to those famous dot plots showing where committee members thought rates were going, right down to very carefully orchestrated press conferences. By using these tools, the Fed successfully minimized surprises. Volatility stayed lower simply because investors weren't caught off guard. And man, investors loved it. I mean, it was literally like getting the answers to the test before you even sat down in the classroom. Which brings us to Section 3, why the strategy evolved, or more accurately, why the playbook broke. Look at the contrast here. During the stable era, conditions were normal, prices were stable, and global supply chains just flowed seamlessly. Forward guidance thrives in a perfectly predictable environment like that. But then we entered our current disruptive era, and things completely broke down. When you combine a global pandemic, really persistent inflation, and severe supply chain disruptions, long-term signaling becomes practically impossible. It forced the Fed to pivot heavily to incoming economic data. Because, let's be real, you simply can't give the market a reliable one-year forecast when you don't even know what the inflation numbers are going to look like next month. The world just shifted way too fast, and the Fed's GPS completely lost its signal. And this perfectly illustrates our jarring new reality. The old playbook was all about forward guidance, comfortable long-range hints, and lower volatility. But the new playbook? It is fiercely data-dependent. It's evaluated meeting by meeting, and it requires a ton of flexibility. The Fed is no longer promising us a smooth ride. They're basically driving by staring right out the windshield, reacting to every single bump in the road in real time. Let's look at what this means in practice. Section 4. Impact on Forex markets. The new volatility. This is the million-dollar question, right? How does the disappearance of the Fed's reliable, long-term signals actually change the way traders operate day to day? If you're trading currencies, the US dollar is the absolute center of your universe, and its value is inextricably linked to the Fed's interest rate decisions. So without those comfortable clues to rely on, what are you supposed to do? Well, because the market isn't getting those advanced signals anymore, professional traders are now forced to monitor the entire economic calendar. They know that any one of these single data points can trigger massive moves in the dollar, long before policymakers even step up to a microphone. Back in the day, you might just wait around for a Fed press conference. But now, a hot inflation number, a surprise employment report, or even unexpected retail sales can instantly flip the market's expectation of what the Fed will do next. The volatility has migrated from the Fed's podium straight onto the economic data calendar. Every single release is now a high-stakes event. Which naturally leads us to Section 5, how brokers should adapt, moving from speculation to education. For Forex brokers, this new era of unpredictability is actually a massive opportunity. Instead of just reposting chaotic breaking headlines, brokers can build incredible authority by following this super simple 3-step communication playbook during major Fed events. Step 1. Simply explain what changed in the data. Step 2. Explain why it actually matters to the broader macroeconomic picture. And step 3, this is crucial, outline what traders should be watching next. In a world where the Fed is no longer holding the trader's hand, brokers who step in to provide that missing context become incredibly valuable. You evolve from just being a trading platform to being a true, trusted partner. I absolutely love this thought. Trust isn't built when markets are predictable. It's built when clients need clarity the most. When markets get harder to interpret, providing clear, impartial education and macroeconomic insights becomes your ultimate competitive advantage. I mean, anyone can look like a total genius in a straight-line, predictable market. But when the data gets messy, when volatility spikes, and when fear starts creeping in, that is exactly when traders remember who actually helped them understand what the heck was happening. To wrap up this explainer, I want to leave you with a final provocative thought to chew on as you build your brokerage brand in this highly volatile new era. If the Fed is no longer guiding the market, who will your traders look to for direction tomorrow? This shift from forward guidance to data dependency has fundamentally rewritten the rules of market communication. The opportunity to step up and be that definitive voice of clarity has literally never been bigger. Thank you so much for joining me as we unpacked this fascinating shift today. Keep learning, keep asking the big questions, and I'll see you in the next explainer.